Hey traders, welcome back to. Today, I'm giving you my top 10 strategies to win with pocket option trading. Whether you're a beginner or seasoned trader, these tips are going to help you make smarter decisions and lock in those profits. We're talking about everything from mastering the basics to practicing patience. Each tip is designed to enhance your trading experience and boost your success rate. So grab a notebook, get comfortable, and let's dive into these strategies. Let's get started. First things first, know your platform. Understanding the ins and outs of pocket option is crucial for your trading success. If you're new to pocket option, take time to explore its features. Practice with the demo account before risking real money. The demo account is a fantastic way to get a hands-on feel for the platform without any financial risk. Familiarize yourself with the different assets, timeframes, and tools available. Each asset has its own characteristics, and understanding these can give you an edge in your trading strategy. Start by understanding the interface. Knowing where everything is and how to access it quickly can save you valuable time during trades. Pocket option offers a variety of tools and indicators that can help you make better trading decisions. These tools can provide insights into market trends and potential trading opportunities. Spend some time getting to know how each feature works and how it can benefit your trading strategy. The more familiar you are with these tools, the more effectively you can use them to your advantage. Make use of the demo account. It's an invaluable resource for testing out new strategies and getting comfortable with the trading process. This is a risk-free way to practice your trades and get a feel for the market without putting your money on the line. Use this opportunity to refine your skills and build confidence. Also, familiarize yourself with the different types of assets available for trading. Each asset class behaves differently, and knowing these nuances can help you make more informed decisions. The more you know, the better prepared you'll be to make profitable trades. Continuous learning and staying updated with market trends are key to long-term success in trading. Don't go all in at once. One of the biggest mistakes traders make is betting too much too soon. Start with small trades and slowly build your confidence. This way, you won't lose everything on one bad trade. Starting small allows you to test the waters without taking on too much risk. It's a smart way to learn from your mistakes and refine your strategies without jeopardizing your entire trading account. Small trades also help you manage your emotions better. When you're not risking large sums of money, it's easier to stay calm and make rational decisions. Remember, trading is a marathon, not a sprint. By starting small, you give yourself the opportunity to learn and grow at a steady pace. Pocket options 60-second trades are great for quick profits, but you have to be smart. Watch the market closely before entering and avoid trading in unpredictable moments. Timing is everything in short-term trades. 60-second trades can be incredibly lucrative if you know what you're doing. They offer the opportunity to make quick gains, but they also require a keen eye and quick decision-making skills. Before entering a 60-second trade, take a moment to analyze the market conditions. Look for clear trends and avoid trading during times of high volatility. It's also important to set clear entry and exit points. Practice makes perfect. Use the demo account to practice 60-second trades before risking real money. Indicators like the RSI or Relative Strength Index and moving averages can help you spot trends. These tools are essential for traders who want to make informed decisions. If the RSI is overbought or oversold, it's usually a signal to buy or sell. For instance, an RSI above 70 often indicates an overbought condition, while an RSI below 30 suggests an oversold condition. Learn to combine these tools for better accuracy in your trades. Using multiple indicators together can provide a more reliable signal than relying on just one. The RSI is a momentum oscillator that measures the speed and change of price movements. It helps traders understand whether an asset is being overbought or oversold. Moving averages smooth out price data to help you identify the direction of the trend. They can be simple or exponential, each offering different insights. Combining the RSI with moving averages can give you a more comprehensive view of the market. This combination can help you confirm trends and potential reversals. For example, if the RSI indicates that an asset is overbought and the price is above the moving average, it might be a good time to sell. This dual confirmation can increase your confidence in the decision. Conversely, if the RSI is oversold and the price is below the moving average, it could be a good buying opportunity. This strategy helps in identifying potential entry points. Take the time to learn how to interpret these indicators correctly. Mastering these tools can significantly enhance your trading performance and help you make more informed decisions. Don't ignore the news. Major economic events and announcements can shift the market in a second. Keep an eye on financial news. This will help you avoid trading during volatile times and instead capitalize when the market is stable. Market news can have a significant impact on asset prices. Economic indicators like GDP reports, unemployment rates, and interest rate decisions can cause sudden price movements. Being aware of these events can help you make more informed trading decisions. Follow financial news websites and economic calendars. These resources provide real-time updates on important events and announcements that could affect the market. By staying informed, you can anticipate potential market movements and adjust your trading strategy accordingly. Use market news as a tool to identify trading opportunities. Don't scatter your trades across too many assets. Stick to one or two that you understand well. By focusing, you'll get to know the patterns and behaviors of those markets, increasing your chances of making profitable trades. When you focus on a limited number of assets, you can dedicate more time to researching and analyzing them. This deeper understanding can help you make more accurate predictions and better trading decisions. Each asset has its own unique characteristics and behaviors. By specializing in one or two assets, you'll become more familiar with their patterns and trends, making it easier to spot trading opportunities. Focusing on a few assets also allows you to develop and refine specific trading strategies. Always know when to walk away. It's easy to get greedy and keep trading, but setting a clear profit goal for the day will help you manage your emotions and avoid overtrading. Setting clear profit goals helps you stay disciplined and focused. It gives you a target to aim for and helps you avoid the temptation to keep trading after you've reached your goal. When you set a profit goal, make sure it's realistic and achievable. Having a clear profit goal also helps you manage your risk. By knowing when to stop trading, you can avoid the risk of losing your profits in a series of bad trades. Finally, don't forget to celebrate your successes. Never risk more than 5% of your trading account on a single trade. This rule is fundamental for any trader, whether you're a beginner or an experienced professional. This is crucial for protecting your capital and ensuring long-term success in the market. By adhering to this rule, you can avoid catastrophic losses that could wipe out your account. If you lose, you still have enough funds to keep trading without panicking. This helps maintain a clear and focused mindset, which is essential for making rational trading decisions. Risk management is one of the most important aspects of trading. It involves not just limiting your losses, but also maximizing your potential gains by making informed and calculated decisions. By limiting the amount of money you risk on each trade, you can protect your capital and ensure that you have enough funds to continue trading even after a loss. This disciplined approach can make a significant difference in your overall trading performance. One way to manage your risk is to use stop-loss orders. These orders are essential tools for any trader, as they help you automatically exit a trade when the market moves against you. These are orders that automatically close your trade when the price reaches a certain level, limiting your losses. This ensures that you don't hold on to losing positions for too long, which can be detrimental to your trading account. Another important aspect of risk management is position sizing. This involves determining the appropriate amount of capital to allocate to each trade based on your overall account size and risk tolerance. By using proper position sizing, you can ensure that you're not risking too much on any single trade. This strategy helps you maintain a balanced portfolio and reduces the impact of any single loss on your overall account. Keep a trading journal. Every trade, win or lose, teaches you something. Writing down why you entered a trade, what went right, and what went wrong will help you improve over time. A trading journal is an invaluable tool for any trader. By keeping a record of your trades, you can analyze your performance and identify patterns and trends in your trading behavior. When you write down the reasons for entering a trade, you can gain insights into your decision-making process. Tracking your wins and losses can also help you identify which strategies are working and which ones need improvement. Reviewing your trading journal regularly can help you stay motivated and focused on your long-term goals. Trading isn't about getting rich quick. It's a marathon, not a sprint. Be patient with your progress and take your time to refine your strategies. Over time, this discipline will pay off. Patience is a key virtue in trading. It's important to understand that success doesn't happen overnight. One way to practice patience is to set realistic expectations. Understand that there will be ups and downs along the way, and don't get discouraged by short-term setbacks. Focus on your long-term goals and stay committed to your trading plan. The more you practice patience in your trading, the better you'll become at managing your emotions and making rational decisions. Alright, those are my 10 tips for winning with pocket option trading. Remember, success comes with time, patience, and discipline. If you found these tips helpful, make sure to like, subscribe, and join us at pip&wave for more trading strategies. Let's make those trades count. 10 for the win. Thank you for watching. Don't forget to subscribe to our channel and hit the notification bell so you never miss an update. We have plenty of more tips and strategies coming your way, so stay tuned and keep trading smart.